Here's a question I want you to think about right now. You and your spouse have spent 30, maybe 40 years building your retirement, saving, planning, making sacrifices, and you finally got there. But what if I told you that everything you built could be cut in half, almost overnight, not because of a bad investment, not because of overspending, but simply because one of you passes away first? This happens to thousands of couples every single year. And the painful part? Most of them never saw it coming because their plan looked perfectly fine on paper. Today, I'm going to show you what financial planners call the widow's penalty. I'll explain exactly why it happens, and I'll give you a simple 3-question test you can do tonight at your kitchen table to find out if your plan is at risk. Hi, I am Imran, the instructor of finance courses and data analyst. So, what exactly is the widow's penalty? It's this. When one spouse passes away, most households lose between 30 and 50% of their monthly income immediately, not gradually, overnight. And here's the cruel part. Your bills don't shrink with it. The mortgage is still due. Property taxes don't go anywhere. Groceries, utilities, health insurance, all still there. In fact, health insurance often gets more expensive because you lose the benefit of being on a couple's plan. Half the income, the same expenses. That gap is the widow's penalty. And it hits in 3 places most couples never even think about until it's too late. First, Social Security. Right now, you and your spouse each receive a monthly check. When one of you passes away, the smaller check disappears entirely. You keep only the larger one. So if your spouse was collecting more than you, your income just took a serious hit the very next month. Second, pension income. Many pensions have what's called a single life option, which pays more while both of you are alive, but pays nothing to the surviving spouse. If your plan was built around that bigger number, your spouse could be left with no pension income at all. Third, investment accounts. This one surprises a lot of people. In many couples, one person handles the money. When that person passes, the surviving spouse suddenly has to manage accounts they've never touched while they're grieving. That emotional pressure can lead to big, costly mistakes. Let me give you a real-life example. Let's talk about Bob and Linda. Bob and Linda are both retired. Bob collects $2,400 a month from Social Security. Linda collects $1,600 a month. Together, that's $4,000 a month, and their budget is built around exactly that number. Then, Bob passes away. Linda keeps the higher check, Bob's $2,400, but her own $1,600 disappears. Just like that, her monthly income drops from $4,000 to $2,400. That's $1,600 gone every single month, $19,200 less every year, and her bills haven't changed by $1. Now, Bob and Linda weren't careless people. They did everything right. They saved diligently, they planned. But their plan was built for 2 people. It was never tested for 1. Is your plan tested for 1? We're going to find out. Keep watching. There are 3 mistakes I see again and again in retirement plans for people in their 50s and 60s. And I want you to listen carefully, because even one of these can put your surviving spouse in real financial trouble. Mistake number 1, claiming Social Security too early. If the higher earner in the household claims Social Security at 62, you get a permanently reduced benefit. And that's the number your surviving spouse will live on for the rest of their life. Waiting until 70 could mean hundreds of dollars more per month, forever. For a lot of couples, that difference is the gap between comfort and struggle. Mistake number 2, choosing the wrong pension option. When you retire with a pension, you're often asked to choose, do you want the higher monthly payment that stops when you die, or a lower payment that continues for your spouse? It sounds tempting to take the bigger check. But if your spouse outlives you by 10, 15, or 20 years with no pension income, that decision becomes devastating. Mistake number 3. No investment plan for the surviving spouse. If you're the one who manages your household investments, I need you to ask yourself something honestly. Could your spouse take over tomorrow and know exactly what to do? If the answer is no, or even probably not, that's a problem that needs to be solved right now, not after the fact. All right, here's the test I promised you. Grab a pen and a piece of paper. I'm serious. Pause the video if you need to. Question 1. What does your monthly income look like if only one of you survives? Write down the higher of your 2 Social Security checks. Then check your pension. Does it have a survivor benefit? If yes, write that down too. Add it all up. That is your survivor income number. Question 2. What are your fixed monthly expenses? The ones that don't go away. Mortgage or rent, property taxes, car payment, utilities, health insurance, food. Write all of that down and add it up. Question 3. Is your survivor income larger than your fixed expenses? If yes, you have a foundation. There's room to breathe and adjust. If no, or if it's close, you have a gap, and that gap needs a plan. Most couples who do this exercise are genuinely surprised, not because they did anything wrong, but because no one ever sat them down and asked them to run this specific scenario. Here's the good news, and I want you to really hear this. If you found a gap in that test, it is absolutely fixable, but only if you act while you still have time. There are 4 strategies that can protect your surviving spouse. Number 1, delay the higher earner's Social Security to age 70 if at all possible. Yes, that means waiting longer, but it locks in the highest possible monthly benefit, and that is what your spouse will live on for the rest of their life. It's one of the most powerful gifts you can give them. Number 2, choose the joint and survivor pension option. The monthly payment will be a little lower, but your spouse will never be left without income if you pass first. That peace of mind is worth more than the extra dollars. Number 3, use life insurance as income replacement. Not as a grief payment, but as a way to fill that income gap for 10 or 15 years. A financial advisor can help you calculate exactly how much coverage you actually need. Number 4, build what I call a widow-ready account. This is a simple, accessible savings or investment account that your spouse can manage on their own with clear written instructions. No complicated strategies, no confusing funds. Just a clear, easy plan they can follow independently. The widow's penalty is not a random tragedy. It's a predictable gap, one that gets created when we plan for life together but forget to plan for life alone. The person you love most deserves to be financially secure, not just while you're both here, but after too. So I want you to do one thing today, just one. Sit down with your spouse, run those 3 questions, and see where you actually stand. That conversation, right there, could be the most important financial decision you make this year. If this video helped you, please share it with another couple you care about. They may not even know this is something they need to look at. You've worked too hard to leave this to chance. Take care of each other. I'll see you in the next one.